Brad Williams, Frugal Finance. We're going to get into expected returns. We're going to get into valuation, maybe a little corporate finance. Here is the role here. This is the way I'm going to play this out. There are 4 valuation related courses. Each has about 6 or 7 lessons. This is my passion. I love doing valuation. Here's the problem. I go off on tangents. I could spend hour after hour after hour talking about this. These are condensed courses, and for the most part, it is notational. In other words, it's written out. I have to follow a script. Otherwise, these 15-minute courses can go on for 2 hours, and that's not the objective here. I'm going to try to condense this information. This is all about expected returns. What is equity risk and expected returns? I'm going to assume you know a little bit about finance. You maybe have looked at some project finance or valuation. So this will be sort of project finance valuation mushed together. I'm going to follow a script like I have in every other session. I'm going to read because it's quicker and it'll keep me on track. What is equity risk and expected returns? To see how risk is seen in finance, we will explain the analysis in 3 steps. First, we will identify risk in terms of the distribution of real returns around and expected return. Second, we will distinguish risk that is specific to an investment or a few investments and risks that affect a much larger sample of investments. We will reason that when the large institutional investor is properly diversified, it is only that latter risk, called market risk, that will be rewarded. Third, we will look at different models for computing this market risk and the expected returns that go with this risk. Measuring risk. Investors who invest in an asset demand a return over the time horizon that they own the asset. The real return that they gain or lose over this time frame may be significantly different from the expected return, and this is where the risk comes in. Consider an investor with a 1-year timeline buying a 1-year treasury bill or any other risk-free 1-year bond with a 3% expected return. At the end of the 1-year timeline, the actual return that this investor would make on this investment will always be 3%, which is equal to the expected return. Return distribution for this investment is shown in image 1.1. The probability equals 1. It is riskless. The expected return will be the 3%. This is a riskless investment, at least in nominal terms. To see a difference, think about an investor who invests in, granite construction. This investor, having completing his research, may presume that he'll make an expected return of 30% on granite construction over his 1-year investment period. The actual return over this period will unmistakably not be equal to 30%. It could be much higher or a great deal lower. The distribution of returns on this investment is illustrated in 1.2. Here's this probability distribution of returns. In addition to the expected return, an investor now has to think about the following. First, the difference of the actual returns around the expected return is noted by the variance or standard deviation of the distribution. The larger the spread of the actual returns from expected returns, the bigger the variance. Second, the bias towards positive negative returns is noted by skewness of the distribution. Look here, we're going to look at low variance, high variance, and then the skewness will be how narrow, how wide are the distributions. That's the skewness. The distribution above is positively skewed since there is a greater chance of large positive returns than large negative returns. Third, the profile of the tails. The tails are these ending pieces here, which give you a lot of information if you remember your statistics. The profile of the tails of the distribution is measured by the kurtosis of the distribution. Fatter tails lead to higher kurtosis. In investment terms, this captures the tendency of the price of this investment to pop in either direction. With a normal distribution, returns are symmetric, and investors do not have to be concerned with skewness and kurtosis, since there is no skewness and a normal distribution has a kurtosis of 0. In this instance, one could state that investments can be identified only two ways. The expected return on the investment is the reward, and the variance, the anticipated return, is the risk of the investment. Image 1.3 illustrates the return distribution of two investments with symmetric returns. Expected return. In this example, an investor faced with an alternative between two investments with identical standard deviations but different expected returns will generally select the investment with the higher expected return. Generally, when distributions are neither symmetric nor normal, it is possible, though not likely, that investors will choose an investment based only on the expected returns and the variance. If they have utility function that let them do so, it is better that they select positive skewed distributions to negatively skewed ones, and distributions with a lower chance of pops, lower kurtosis, over those with a higher chance of pops, higher kurtosis. In this likelihood, investors will swap the good, higher expected returns and more positive skewness against the bad, higher variance and kurtosis in making investments. On the various risk and return models, one, the capital asset pricing model, or the CAPM, clearly notes that preferences be made simply in terms of expected returns and variance. Although it pays no attention to the skewness and kurtosis, it's unclear how much of an issue these factors in determining expected return. The assumptions we make when we use historical variance is that past returns are a good indication of future returns. When this belief is violated, as is the case when the investment's characteristics have altered widely over time, historical estimates may not be good measures of risk. Calculation of standard deviation using historical returns. We collected the data on the returns we would have made on a monthly basis for every month from July 2015 to August 21 on an investment in Granite Construction, publicly traded company. To compute the returns, we looked at the price change in each month, with price at T being the price at the end of the month, T, and dividends, if any, during the month, dividends J. The return is price at T minus price at T plus dividends. Granite Construction returns identify the risk that an investor in the stock would have dealt with over the time frame, with November 2020 being the best month, with a return of 27.5%, and October 2019 representing the worst month, with a return of negative 26.9%. Reviewing the summary statistics, the average monthly return on Granite Construction over the 59-month period was 1.20%. In fact, we started the period in July 2015 with a stock price of $31.12 and ended the period on August 2nd, 2021 with a stock price of $37.78. However, the stock did pay an annual dividend of 52 cents in 2015 and 52 cents in 2021. To gauge the volatility or risk in the stock, we calculated the standard deviation in months returns over this period to be 10.09%. That's huge. The variance in monthly returns was much higher, 31.76%. That means this stock moves around quite a bit. To adjust monthly values to annualize one, annualized standard deviation, you take 10.09, which is the monthly standard deviation, times the square root of 12 is equal to 34.95%. That being said, a 34.95% standard deviation means two standard deviations would take this out to 70%, and I don't think there's that much volatility. I think I've been in a hurry the last few days and I updated this. Probably should be 0.109 times 12, and we would come up with a much smaller number. Looking at Granite Construction standard deviation in stock returns without comparing stock returns of other companies gives us little or no evidence whether Granite is a risky investment or not. Brad Williams, Frugal Finance. Thanks for watching.